Welcome, everyone, and thank you for joining us on today's webinar, Demystifying Private Equity Compensation. My name is Lauren Horan. I work in the marketing team at MLA, and I'm going to be your moderator behind the scenes today. Our hosts today are Bob Graff, who is a partner in our in-house recruiting team, and he's also the co-managing partner of our Atlanta office, and Anna Gorodetsky, who is a managing director in our in-house recruiting team based in San Francisco. We're really excited to have you here today, and before we get started, I just have a few admin items to go over. All attendees are in the listen-only mode, so your lines are muted and your cameras are off. We are recording this webinar, and it will be available on our website within the next few days, and all attendees will also receive an email with the recording. We expect the webinar to be an hour in length, and we are hoping to have time for Q&A at the end. So we welcome questions at any time. Just click on the Q&A button at the bottom of the screen if you'd like to ask a question, and as they come in, I'll be moderating them from behind the scenes. If we don't have time to get to your questions, we will follow up with you after the webinar. We will also have a quick post-webinar survey, just a couple questions to let us know how we did and if there are any other items you'd like to learn about from MLA. So now I'm going to hand over the reins to my colleague Bob, who is going to set up today's conversation and will introduce our esteemed panelists. Thanks.
Thanks, Lauren. We greatly appreciate it. And if you're unhappy, just don't fill out the survey, right? So I am going to ask our panelists to introduce themselves just briefly. All three are people we've known for a long time, two of whom have had the misfortune of being placed by me. So we're going to have some fun today, and I think you're going to gain a lot of insight. So why don't we, on my screen, Chris is the first one I see. Why don't we start with Chris?
Thanks, Bob. Chris Matan, General Counsel at MaintainX, a software as a service company. We are venture-backed, which is certainly relevant to this discussion. Over my career, I have been a partner at a large law firm working with venture-backed and PE-backed companies, joined one of those companies, Bandwidth, and was with them for an extraordinary run between 2010 and 2021. So I've seen that journey from venture-backed to public company as well, and looking forward to the conversation.
Nice. All right, Miss Sarah.
My name is Sarah Powell. I'm Executive Vice President and General Counsel for Go-To Foods, which was formerly known until 2 weeks ago as Focus Brands. I've been with the company for about 9 years, and we're private equity owned. Before that, I was with Advanced Auto Parts, which was a public company. So I've had experience in both the public and the private sectors.
All right, Sarah, give us a couple examples of go-to brands besides Cinnabon, which is my favorite.
You got to get them all. Auntie Anne's, Jamba, Carvel, McAllister's Deli, Slatsky's Deli, and Moe's Southwest Grill.
There you go.
Go-to foods.
How many years did it take you to memorize that? But all right.
No time at all. I like all the brands.
There you go. Great stable of brands. All right. And John, last but not least, my buddy John Camperlingo.
Thanks, Bob, and good afternoon, everyone. I'm John Camperlingo. I'm the Chief Legal Officer at PharmScript, which is a pharmacy company that provides care to long-term care facilities, such as SNFs and assisted living facilities. Prior to, it is private equity backed as well. And before that, I was with another private equity backed company called Unified Women's Healthcare, where we took it from a small peanut to a watermelon over a 4-year period of time. And prior to that, I was a general counsel for a publicly traded company in Atlanta called Gentiva Health Services, which was acquired by Kindred in 2015. 36 years of legal and compliance experience, and began my career as a judge advocate in the Marine Corps.
There you go. We thank you for your service in that. And John, did Gentiva, were they taken private at some point? I'm trying to
they were not. It was close when we blew a covenant on our debt, but it was not by desire. More
2008.
Like, yes, exactly.
You were in good company. So
yes.
You were in the majority. All right. Well, thank you for that. Anna and I, we talk about all this stuff, but the panelists have lived it. So I think you're gonna learn a lot. So we're gonna start with just a quick kind of brief overview of public company equity compensation, which you're probably familiar with, but just as kind of a baseline. And Anna is going to do that for us.
Yes. So as most of you know, most large public companies these days grant RSUs and occasionally some options that typically vest a third or a quarter per year over a 3 or 4 year period. And the options offer more upside, whereas RSUs offer protection on the downside. Most public companies generally pay higher cash compensation and less in equity compensation for similar roles than private equity or venture capital backed companies. And in the private equity world, most GCs receive a one-time grant of options. So generally, private equity owners try to pay less in cash and more in equity to better align incentives between the private equity owners and the management or executive team. So today, together with our wonderful guest speakers, we will cover 3 topics. First, what form does equity participation take in the private equity and venture capital backed companies? Secondly, how much equity should a prospective general counsel or chief legal officer ask for? And third, what happens when there is a transaction? Bob, turn it over to you.
Awesome. And Sarah, does that description of public company compensation, does that jive with your experience? I know you were at a public company earlier in your career.
Yes, very much so. During the time that I was at Advanced Auto Parts, I believe we had about 35% of my salary was in stock, and we had 25% RSUs and 75% option grants. When I first started there, it was actually all option grants. So they switched to the RSUs during that time period. And I think most companies have service for half of it and performance targets for the other half. Seems to be pretty consistent across the board. That's what I have at private equity as well. I have seen a few companies, as Anna mentioned, that are going to 4 years and 5 years now, and even some public companies that have cliff vesting, which means that you don't vest until the end of that period versus vesting a third, or a fourth along the way. So an interesting development that I've seen at a few companies in the public sector lately.
Okay. So your equity target was 35% of your base, and that's every year, right?
Yes, that was an every year grant.
At a public company.
Yes.
Yeah. I think you and I might have talked about that once or twice. So, okay, so we are going to move into the private equity world, the kind of the meat of the matter here. As Anna mentioned, often you'll get a little lower cash comp in the private equity world, and you'll get a one-time grant of some form of equity or equity participation. It may or may not be an actual security, right? It might be an option or even just an agreement. And typically the value is talked about in future value terms, which sounds great, right? The question, of course, is, what are you going to do to generate that value? But what we often see is somewhere between $1.5 and $2 million of future value. So I think the key points here are that for the most part, it's a one-time grant. Occasionally you'll have a sponsor or a group that'll sort of reload the equity, but typically it's a one-time grant and the value is talked about in future terms. So John, is that consistent with your experience?
Yes, Bob, it is. And typically they could come in the form of RSUs, as Sarah said, but in the companies that I have been in, they are a profit interest. So you get awarded them depending where you are in the life cycle of the company. And they have growth targets built into them. So in the profit interest world, it'll set, this is where you got a grant and here's where you would hopefully get to at the end of the life cycle of the company. Typically in the private equity world, they talk in the terms of 3 to 5 years. I've seen most of them go a little bit longer than that, but when they're doing the pitch to try to get you on board, you'll hear 3 to 5 years, so that you're thinking that money is coming sooner than it is. The last 3 companies that I have been with have been private equity companies, and they're pretty consistently across the board of how the grants go. As you said, one-time grant, and one of the things that I've learned after 2 successful evolutions was, you never make what they're going to tell you you do. So you always got to go there with a little bit of a jaundiced eye and try to ask for a little bit more, because it's always lower than what your dream sheet, so to speak, will show you.
Yeah, lower and longer, right? Longer
Correct.
time period. Yeah,
yes,
it can happen. Yeah. For anyone who's worked with me in the past on these searches, what I usually say is, look, the sponsors are going to tell you it's $1 gazillion of equity in the future, and you're going to have to sit down with the CFO or a managing director from the PE firm and say, all right, help me with the math on how to get to $1 gazillion, right? So that's helpful, John. And as John alluded to, Anna now is going to dive into kind of the meat of this, which is essentially the term waterfall table that you hear, that I'm not smart enough to explain, but Anna's got this, and then we're going to turn it back to our panelists.
Well, no, the panelists are definitely going to be the ones
Yeah.
with the illustrative examples, but yes, let's move on to equity participation in the private equity and venture capital world. Most portfolio companies with private equity owners provide equity participation to their senior members of the management team. And these equity participation units have various names and different acronyms depending on which very expensive law firm prepared the executive compensation documents. Management incentive units, MIUs, is a fairly common term. Profit interest is another term, and there is usually a 3 to 5 year vest on them, either time or performance based or both. And as Bob alluded to, you may have also heard the term waterfall table. This is essentially a table that reflects kind of various levels of return to the investors and a correspondingly increasing share of profits allocated upon a liquidity event to the executive team. So with the general idea that the higher the return that the PE firm receives upon a liquidity event, the more money the management team will receive as well. So if the investors get 2 times their money, for example, the executive team will do okay. But if the investors get 2.5, 3, or 3.5 times their money, the executive team will increasingly share in the profits as a reward, right? So I will now turn it over to the panelists to provide more detailed explanations and some illustrative examples. And why don't we start with John?
Sure. Remember, when you're going through the transaction and the waterfall is being created, you will have eyes on it. I will tell you that first and foremost, as the chief legal officer for 3 private equity companies. So the first thing is, if you hadn't seen it before, you're going to be a little shocked, because you're going to see how it's been distributed throughout the organization. So typically what will happen in a waterfall is you'll get your enterprise value, right? That's the equity value plus the debt, and that's the purchase price of the company. And then through the waterfall, you take out all of the transaction expenses. That will have the debt, because more than likely, if it's private equity, the company's leveraged. Then we'll have investment banking fees. Then it will have, if you have any A shares or B shares, before you get to management, which is usually typically the lowest end of the waterfall, everything else gets paid out before we get into what your management team is going to receive. Now, typically, in quality private equity companies, management shares in anywhere between 15–18% of the company. So all that means is you're just going to get a smaller percentage as all those expenses go out, because again, you have legal fees to go through it. Remember, the private equity team is never going to give any of their equity out. And when that transaction occurs, and you'll be the one probably doing the setup of the wires and getting all that information, the waterfall will follow along the following path. The A shares usually go, and that's usually the initial investor, the private equity investor, or the founders. A B unit that will have a corresponding value. Again, those are essentially different classes of shares. Typically, the private equity world is in an LLC, and Chris will talk to you about something a little bit different, which happens in the venture world. And then the profit interest will go, and it'll get passed down to the management as the final. The management incentives are always usually the last in the preference there. Anna, did I answer your question? Yes, go ahead, Bob.
Yeah, you did. So John, who would get a B share? Would that be like if there's an additional round of investors, or would that be like maybe a CEO or?
It's a great question, Bob. Typically what will happen you're going to do acquisitions to grow that business, right? So if you get an acquisition from another company and you want them in, they're not going to share in the A because they weren't there at the beginning, but the board will create a share class to give compensation and incentives to anybody who's acquired. And additionally, what I've seen in the past is when they go out and they do a search for the CEO is permitted to invest in the company, pays a little bit of money, and then gets the B shares. So that's really kind of tying him to the growth of the company and hitting the mission of where the private equity group wants to go.
Gotcha. Okay.
I'll just add maybe before Chris starts on VC, a little bit different experience that I've had is option grants. But I think it works the same way in the end because all the debt and everything would come out before you actually get your share under the option grant. So it's probably very similar, but all option grants, no RSUs. So more invested in the results of the company.
Yeah. Okay. Thanks, Sarah. And Chris, how does that compare sort of to the venture capital world that you've lived in?
Yeah, as Sarah said, in many respects, the end result ends up being similar, but the structure is radically different. As Sarah alluded to, typically when you join a venture-backed company, you only get options. You would not get restricted stock units at a venture-backed company because prior to going public, it would be an adverse tax consequence that most people would not want. So it's almost always options. And the options are granted at a then current fair market value. You'll hear the phrase a 409A valuation, and that is attempting to value the shares. So you then have obviously the upside opportunity that the option represents. Where there's the similarities come into play is that when you have an option, it is customarily for common stock. Typically, the investors would have had preferred stock. The preferred stock has what are commonly known as liquidation preferences. Those liquidation preferences effectively create a waterfall, meaning that the debt first would have to get paid, then all of the liquidation preferences associated with the preferred stock bought by the investors, and only then is there money available for the common holders, aka the management team, and frequently in a VC-backed company, the entire company or something approximating the entire company. So as Sarah said, it does yield kind of a very similar result based on outcome after you've paid off down the way and the common end up participating.
Nice. Okay. And we're seeing some questions in the chat box that I'll try to throw out when they're relevant. So how one of the questions is, do you get to see the waterfall table? The person who submitted the question, I think, has had an experience where maybe they were not, the PE firm or the VC firm were not super happy to turn it over. And that's been my experience as well. I mean, John, you made the point that once you're on board, you see it because you're the general counsel, you sort of administer it. But what's been your experience? We'll maybe go in reverse order. Start with Chris in terms of during the negotiation, do you typically get to see that table or no?
Yeah, when I first left the law firm to join Bandwidth, I saw it because I'd been the guy maintaining the cap table prior to joining. So I already knew everything anyway.
Yeah. And cap table would be a similar term to waterfall. I mean,
correct.
Who's got what in terms of equity?
Correct.
Okay.
Correct.
So I'm just a simple recruiter, guys.
Yeah. And so in the context of the other venture-backed companies that I've been with, in each case, I've gotten visibility into it because they know that you will be seeing it immediately upon joining. So as a result, I've not seen people have reticence to providing that information.
And Sarah, I'm going to guess your experience might have been different, but you might be muted, Sarah. There we go.
Yeah, sorry about that.
That's right.
Yes, so we don't have the waterfall, as I said, but I do have access to the cap table, but it's very limited who has access to the cap table. And
as I recall, neither you nor I had access to it when you were coming in, right?
As I recall, that's right.
Yes, vaguely. Sarah's comment, I think, is important because typically the general counsel would see it. If you were coming in as an in-house counsel below the general counsel level, then you probably would not be seeing it. Yeah, well, Sarah came in as the general counsel, but it just wasn't. It wasn't shared. Yeah, I know that a
until
lot of our
after.
participants might not be coming in as GCs, so they might not be expecting to see that.
Yeah, that's a great point, Chris. It really is. And that's a tough one. I mean, this kind of gets to the meat of the matter. I mean, the reason we wanted to put this on is because, you know, there are so many people, so many great lawyers that we deal with who just haven't had this experience before, and you don't even know what questions to ask. I mean, Sarah, is there, knowing what you know now, what, 8 years into PE, are there different questions you would ask on the front end? And then we'll get to John in a sec.
Yeah, I mean, I would probably ask to see the cap table. I think something that we may discuss later is if you, what happens if you leave the company voluntarily or involuntarily? Do you have to exercise that kind of thing? I would probably look at more closely. And I would like to see the cap table to kind of compare with other people in the company. I think mine is fine, but I would want to see that going into any other company.
Yeah, and we're going to talk about, you know, how much to ask for in just a second. But before we talk about how much to ask for, we have to, you know, of what, right? What are we talking about? And John, what's been your experience on your ability, because I know you've done this several times, to kind of see what the preferences are and who's ahead of you on the waterfall?
I've had mixed success. Some have provided it, some have not. I mean,
Did you have to go Marine on them?
Yeah, well, you know, when we were prepping for this, Chris made a really poignant comment that hit home with me, and that is, you know, you're going in as a chief legal officer. You're on the executive team, and the years ago when I first started in this business, the lawyer was kind of put in the corner. That is not so much the case anymore. You're part of the business team. You're arm in arm, as it was to coin Chris's phrase. You're arm in arm with the management team here. And if you're going to be a consigliere or a counselor to the CEO, you're going to share his inner darkest secrets, because he's going to come to you, or she's going to come to you early on any transaction. So it really does set the tone for trust. The other thing that I would ask going in, you know, companies get sold at different multiples, because that really drives what your value is going to be at the end of the day. And, you know, research and market data and see what kind of market data there is out on the company and the industry is super helpful. The last private equity company multiple we sold at was 17 times earnings. My current one, you know, if it gets 6, it'll be a good day, you know, because it's just the industry, times change. So keeping up on that and making sure that you have a good understanding of where it fits in the industry or in the marketplace is vital. And you should get whatever information they have on that, and they have tons on it, because they wouldn't have invested in the space before they asked you to join on.
Yeah, I think that's a great point, John. And you know, I guess we're mostly, at least in the PE world, we're talking multiples of EBITDA, I guess, right? Some sort of gross measure of earnings. One of the questions we had was just, are the payout, I'm not sure I fully understand it, but are the payout multiples typically the same for all levels? And I'm trying to understand what we're getting at there, but I mean, the multiple John's talking about here is what the company is sold for. And then, as I understand it, I think the waterfall table then determines who's ahead of the management team in terms of getting a return. Obviously, there's a pool of investors in the private equity pool, right, that expect a certain return. And so the waterfall is, as the investors' returns go up, so does management's, because it's essentially a goal alignment tool.
It's really going to depend upon how the original investors set up their preferences and how that waterfall works in the current company. They're going to get a higher multiple based on certain levels that they hit, and they'll get paid out better than the management team. Yeah. But it really depends, and that you're not going to get that before you walk in the door, for sure.
And Chris, is that consistent with your venture capital world?
Yeah, I think that's exactly right. It's definitely consistent.
And there's another question.
Go ahead,
any
Anna.
suggestions on how to handle a private equity company that has diminished in value, and there have been capital calls and otherwise dilution to your profit interest shares?
Contact Bob Graff and Anna. And
Bail? Is that what you're saying, John? Just bail?
Yeah, maybe.
Don't reach for your wallet?
Well, that's again, knowing your industry. You know, one of the things that I think over the course of 36 years of practicing and most of that time has been in-house, was really the need for the general counsel to kind of understand the business and understand the industry that you're working in, so that you can stay a little bit ahead of that. You know, in this pharmacy company that I'm working for, and it's really like a CVS that just services, you know, nursing homes and assisted living facilities.
Mhm.
You know, who would have foresaw that, you know, by the stroke of a pen, the government decided to reduce the rates on injectables for insulin. Well, that had a devastating effect on the company's valuations. You're not going to know it all the time, but staying attuned to that will avoid situations where you are having that diminution in value as you're going through your tenure.
One thing that I would add is, you know, there's less volatility when you're in private equity, except if some big event happens like that. So a positive I would say is that if your company is doing well, it's less likely that the value is going to decrease. While if I look at the Advanced Auto Parts stock, it's $100 less a share than when I left. So very volatile stock that's had some issues with turnaround, and the public reacts to that. So I don't face that in private equity as much.
That's another reason you love me, Sarah.
There you
We
go.
got you out of there, right?
Yeah,
Depends
I'll
on
just-
the year.
yeah.
Go ahead, Chris. Yeah.
I'll just quickly add that, you know, certainly venture tends to be much more volatile. You can have situations where you've raised considerable amounts of capital, and suddenly there is no scenario in which the company will be sold for a number greater than the amount invested, which means that your common stock that you hold options for as a management team member are worthless. And under those situations, what typically happens is that the investors find a way to create a structure to incentivize the team in some way. That probably, so it definitely is one of those things where if you're on the team, you should expect that something will happen in the venture world where you see that remarkable compression.
Yeah, it's tricky. And John, you made a great point earlier on understanding how companies are bought and sold in your particular industry. I mean, John, obviously you've been focused heavily in healthcare, but you know, we have some clients, Anna and I do, that will share kind of their investor deck, their slide deck, their PowerPoint deck that'll talk about multiples. It'll talk about how we're going to get EBITDA from, you know, 75 million to 500 million or whatever it's going to be, right? And then, you know, what similar companies are selling for as a multiple of EBITDA. And I think what happened last year, and I'm curious as to the panelists' experience with this, is, you know, the cost of debt went up so much from, I don't know, 3 or 4%, whatever people were paying in 21 or 22, to 9% was probably one of the higher ones that I heard, and therefore the multiple that buyers can pay for a company goes down, right? It's kind of like when you're buying a house, you know, you're buying the money and you're buying the house, right? And if the price of the money goes way up, you can pay less for the house. So it seemed to me like last year that there was a sort of a standoff where sellers were saying, well, my buddy who sold her company last year got 30x in you know, the tech world where Chris plays, and the PE firms that Anna and I are trying to work with are like, yeah, well, they didn't pay 9% for their money, so I can give you 20 times. And there was this kind of who's going to blink first, and nobody blinked. I don't think in 23, pretty much everybody I talked to who does M&A was like, yep, it was a boring year. I played a lot of golf. Or tennis or pickleball, but what do the panelists see? What have you seen, Chris? And then we'll go Sarah and then John on kind of the current state.
I think it's still, you know, I think it's a matter of, you know, who do you want to believe of what, you know, what you're seeing. I mean, in my view, the M&A markets have been, you know, fairly muted, but, you know, again, in the context of what I operate in the venture world, to the extent there's delay, it may imply the need to raise additional capital, unlike in the PE world. And so that additional capital means there's that much more above you on that liquidation preference table that I was describing earlier. And so that's the biggest risk of delay in my world.
And Sarah, what are you seeing? I mean, you guys have been inquisitive from time to time.
Yes, definitely seen the issue with the increase in percentage, the interest rates and all that affecting things. I would say overall though, even though the price for the loan may be higher, if your success of your company is greater, that can offset it completely and you still get the multiple that you want to get. So it all depends on, I think, what the circumstances are of your individual company and the success that they're having at the current time.
Yeah, I'm hearing from a number of candidates who say, we finally sold the company. You know, we've been trying to sell it for 18 months and now I need a new job. It's like, okay, great. John, what's been your experience in the current market? It sounds like you've been impacted by government regs as much as you have interest rates, but.
The interest rates definitely had a big impact. And I would just add in a bunch of my friends who do this stuff, and what I've seen is more strategics who have significant amounts of capital that they don't have to borrow on, have been playing in markets that they typically wouldn't. This was a private equity, the step process until, either decided to become a public company or not. You're seeing less and less of that, unless it's a super hot market and somebody's willing to pay ungodly rates for borrowing money. But I have seen the strategics and a few of my friends who are still colleagues are still in playing in the space have seen it as well.
There you go. John, I tried to get you to go to that marina company, remember?
Yes.
But anyway.
I'm still in the market for a boat.
Yeah, I know, right? So a couple questions that have popped up in the chat that I think we're about to get to. So what we've tried to do in this first section was just cover, what is it? Like, what are we talking about? What do you get? And it's amazingly complicated. So the next question, the part two, is we're going to try to move on to kind of what to ask for, right? How much should you be able to ask for? What Anna and I and other recruiters typically try to say to our clients is, look, the GC should be similarly situated with the CFO, right? Obviously, the CEO is going to get the biggest chunk of equity. I'm not sure that we always win that argument about the CFO. I'm not even sure why, but we make that case. And I think I mentioned earlier in the that the kind of that $1.5 million to $2 million in value. But let me run down just some factors that I typically have seen, and then we'll call on each panelist. But some of these are really basic, right? I mean, how many years of experience does the general counsel have as a general counsel and as a lawyer? Has the candidate successfully driven other private equity-backed transactions to a profitable outcome? To Sarah's point earlier, what the other similarly situated executives have as part of their comp package around equity, and that it might be the CFO, it might be the CMO in a marketing type organization, and then I think to the question that was in the chat, when are you coming in, right? If you're coming in as the general counsel, but the CFO joined the firm 10 years ago and was one of the early executives, the CFO might have more equity than you're going to be able to get if you're coming in a later stage. And this last factor is just one I've kind of observed. I don't think there's anything fair about it, but the candidates that I've worked with who've been through it before, they've been through this kind of transaction before, know what questions to ask. And that seems to telegraph to the PE firm or VC firm that, all right, this candidate knows what they're doing. We're going to give them a little more. Well, John, let's start with you. What factors do you see in terms of how much you get?
So Bob, I do think there is this prejudice out there against paying the general counsel or chief legal officer the same as the CFO. If you think about it, you're dealing with private equity groups who are finance people, and it's sort of like when you deal with a physician, there's nobody smarter in the room than a physician. Well, it's the same with the private equity financial sponsor. He is looking at a CFO. A lot of them may have come up that route and then have worked as CFOs before, and their investors will do the same thing. So it's a real battle. I do think, though, over the years, and I'm 36 of them, I've seen the progression that you're also being brought in as an executive, as a leader, and those leadership, management, executive types of functions and traits that you bring to the job are super important, and I think are some of the things that you will need to kind of push them to get to that level. Now, you may not get there, but you're getting as close to them. Again, you're going to work arm in arm. You're going to see all of this stuff. If you know, so long as you're not, 15 years apart from when the CFO joined and you're walking in the door, which you wouldn't want to do anyway, because of the private equity company can't get rid of it. But, just making sure that, you're close in time and close in value. I think that those prejudices are kind of eroding over time. I mean, in my own story, I'm running facilities because I'm in a small private equity company. I'm running transportation. I'm running non-pharmacy procurement, in addition to running a $1 billion legal department. So a company for a $1 billion company, a legal department for a $1 billion company.
Yeah.
So I think that, bringing in those experiences that you have that are going to give you the opportunity to work well with the team will kind of push you to get to that CFO, or as close to the CFO as you can. But it is a bit of an uphill battle for sure.
John, would you say that 30% less than where the CFO is in equity is typical? Do you have any benchmarks for where the GC, assuming the GC came in not too far, time-wise apart from the CFO, where those?
So in my own personal space, I found out 2 weeks after I joined, the CFO who joined after me got double what I got. So it didn't feel good. But in general, 30% is about right from when I'm talking to my colleagues now.
Great, thank you.
My experience has been, the General Counsel has really taken on, as Chris and John have said, a greater role over the last few years. So often it's CEO, CFO, and then General Counsel, or if there's a COO or a president, there might be somebody in the middle there. I have not seen very many GCs get the same as the CFO. CFO would probably step in to replace the CEO if something were to happen with the CEO. So I think most private equity and most public companies see the CFO role as somebody who is supposed to get more equity than the General Counsel. One thing that I think people could look at, and I'll give a hint perhaps, is, you can compare, perhaps if you can find out from public companies what GCs at companies of the same size are getting an LTI, and kind of use that as a negotiation point. And, private equity usually looks at this, as you guys have said, as a one-time grant that's worth X number of dollars in the future. And that future amount is what they're looking at, what is reasonable for a General Counsel to have. So if you can look at other public companies and get some information on that, that can help you in your negotiation.
Yeah, that's a great point, Sarah.
Of the same
Yeah,
size.
similar size companies. That's a really good point, because we work with PE firms, portfolio companies that are 200 billion, or they might be 2 billion in revenue. And the compensation is obviously going to be, not obviously, compensation is going to be a good bit higher the bigger the company, right? So that's helpful. And you also got to divide that future equity by 3 years or 5 years or 8 years, depending on how long it takes, right? So if it's 3 years and you get 2 million, that's great. But if it's 10 years, you probably should have stayed at your previous company, right? In terms of the equity. Chris, what about the VC perspective?
Yeah, I think many of the factors that you and Sarah and John spoke of also apply in the VC world. I think when you sign on as GC of a venture-backed company, you typically would be the first GC. We'll assume that for the moment, which means that the company may not have a whole bunch of metrics. So they may not have a great ability to evaluate what your value will be. They're going to rely upon their investors, other, kind of in the industry comps. I think you should not expect to get what the CFO is getting. As a general rule of thumb, I see 0.25 to 0.6% of the company. So it's, some of where you are within those ranges will of course depend on some of the variables that we've talked about, experience, etc. But those are, very, very similar numbers. I think the only thing that's really key in the VC world is also not only what percentage, but when you arrive. If you arrive at a later stage, your 409A valuation, aka your strike price on your option, is going to be higher. So if Sarah joined as CFO 2 years ago and had an exercise price of 10 cents a share, and I sign on today at $1 a share, and the company sells for $2 a share, even if Sarah and I get the same number of shares, Sarah does dramatically better than I do, which is of course right, because it's correlated typically with risk. Risk being described as how early did someone join the company. In my example, Sarah obviously joined very early.
All right.
We have an interesting question from the audience. Is it appropriate to ask for anti-dilution rights? And how can one protect oneself from a CFO joining after you are getting double? Is that possible?
Sorry, John.
Yeah, looking at it through the lens of the VC world, you are not going to get anti-dilution rights. I mean, in short, you're getting a percentage or a fraction of a percentage of the company, and you, along with everyone on the management team, is subject to dilution to the extent the company needs to continue to raise capital.
I would say the same in my experience on private equity side, but I do think private equity looks very closely at dilution. So they're also making sure that there's not too much dilution in the stock for all the individual shareholders.
I would agree with that, both what Chris and Sarah said. Nothing to add on that, but yep, agree both.
Yeah. Okay. And I guess
that's a tough ask. That's a tough ask to get, unless you're the CEO. But.
Yeah, I've not ever experienced candidates being able to get that, and I've seen everything from the 50-page, agreements written by some super expensive law firm to literally like a page and a half offer letter, and one sentence says, if investors get this, you'll get this dollar amount. I guess if you get go ahead, John.
But yeah, I just want to add one point before you leave on here. One of the things that they did at this company was negotiated a transaction bonus, which gets paid out at the top of the waterfall. It doesn't hurt the private equity, other than it's a transaction expense. It doesn't hit their equity, and those are pretty easy to sell to a compensation committee if you feel like you have a sense that you're 50% less than the CEO, the CFO who joined a month before you. So it's an option, and so what happens is you get paid. It's ordinary income, and you don't get the benefit of the long-term capital gains that you would get from the other vehicles. But it makes up a difference, and it's no skin off their nose.
Yeah, that's a great point, John. That's exactly what I was going to ask you about. So I appreciate you bringing it up. I mean, it just sort of sidesteps the whole equity conversation, right? You say, like, if we have a successful sale, I get 2 million or I get 3 million or whatever. And when you're asking for those, you get, to John's point, you got to remember, 30 or 40% is coming off the top, depending on what state you live in. So maybe what John has.
I moved to Florida.
I don't know. Yeah, I was just going to say that. All right, the last thing we want to talk about, and I'm going to turn back over to Anna. So we talked about, what makes up the equity or the profits participation, how much do you ask for? And then hopefully the last piece of this is, all right, the company is sold. So I'm going to let Anna talk about that.
Thank you, Bob. Before we do that, there's a few questions that we might want to ask. In the VC world, Chris, do you see GCs getting additional option grants to bring them up to the CFO or other management level?
No, as a general rule, you'd be getting a one-time grant at the beginning. Depending upon how things evolved over the way, you and the other members of the management team may get small periodic grants, but that would not be customary, no.
Okay. And then how do GC grants compare to folks other than CFO, like a CTO or a chief people officer? Do you have any data points there? Anyone is welcome to weigh in on that, Chris, Sarah, or John.
I'll weigh in. Typically it's more significant than the chief people officer. It's difficult to say with the CTO because in the context of a venture-backed company, frequently the CTO is one of the founders, which complicates the analysis entirely. So that's probably a tough one to kind of draw an apples to apples comparison.
I would say in my experience higher for the GC, but I will say that not in all companies do even the chief people officer and the CTO and others get stock options or stock grants at all, or any share. So people should just keep that in mind as well.
And John, anything to add on that?
Yeah, about the same. My experiences are exactly the same. That you know, if you're not number 2 or tied with number 2, you're usually number 3 of most of them, again, unless you come in with a technologist that is a founder.
Great. Well, on our last topic, rollover and of equity and such, often private equity firms realize a return on their investment by selling the portfolio company to another private equity firm after 5 to 7 years of ownership. And often as a condition of the sale, the management team is required to roll over some of the equity into the new deal. So I will ask our panelists to clarify in what circumstances will private equity owners require the executive team to roll over some of their equity and what the typical metrics around that are. John, maybe starting with you and your experience on that would be helpful.
Sure. So if the new buyer is smart, they're going to require participation that essentially keeps you incented. They will re-up you with additional equity, but you will have to take a portion of your proceeds and what they call roll them into the new company. Typically, it's 25 to 30% of what you just earned is going to be stuck in the company as an investment, which will take another 3 to 5 years. And even if you decide that, you know, you're going to negotiate and leave and do something else, typically they're not going to let you snake out of there without leaving something. So, you know, that's a real issue for folks. You can try to negotiate it. As I told my last CEO, hey, I'm getting older in life. I can't wait another 7 years. You know, I'm going to be 60 soon. So anyway, that worked. And we got a reduced role, but I still had a role, even though he knew I was leaving. So you could try. And I think that those are standard because the new company needs you to get bought in and they're buying a management team typically in a private equity transaction, who knows the industry, who's worked the industry, who knows the customers, et cetera, et cetera. So that's a big incentive for them.
Is it different, John, if it's a strategic sale, like when you sold Gentiva to Kindred? I mean, that was a strategic buyer. You can take everything off the table at that point?
Yeah, everything was gone. We were day one synergy, so that was even better because you get your employment agreement kicked in as well. So yes, in the current company, the strategic is looking at us and it will be a zero-sum game. There will be no equity roll at all.
Yeah, you were pretty happy after that, as I recall. You were smiling all the time.
I did, yeah. That was a little shocking to get fired for the first time in your life, but welcome, you know.
Fire me, please.
Yes.
And how does this compare with executives who may be hired for the second go around and have no equity or cash in the pot?
Well, again, anybody new that they're going to bring on, they're going to have to, you know, give them equity like we were talking about. So you know, they don't get the benefit of what you've been through, the wars that you've been through to keep that equity there. I mean, it's sort of like the 10-year CFO. If you're coming in as a general counsel, you're getting just a small, you know, you're going to get a smaller piece because they've just been around. So, but they typically, you know, if you have done a good job, they do offer. I found that the equity on the second go round, if the company was successful, was definitely higher. The percentage we talked about before I left was significantly higher than the first one.
Mm-hmm. And what have our panelists seen when the timeline drags out for a successful transaction? Are there additional options or equity participation units granted? Are the initial units fully vested, even if the general counsel leaves the company? What's your experience with that? Maybe Sarah, do you have anything to add on that front?
So I think with private equity, sometimes it's able to get another grant. So I think that's something that definitely people can put on the table. In my case, you know, I actually have to buy out in order to, if I leave or whatever, in my case, I'm not sure that that's common. I think it's pretty common with private equity, but I'd be interested to hear what John's experience on that has been.
Sarah, before we let John jump in, your vesting schedule, as I recall, was like 5 years or something, right? Okay. So you're fully vested, but the problem is there's no market for those units, right?
That's correct.
So you either sell them back to the sponsor or you just hold on to them.
That's correct.
But if you leave, Or you can't,
I have to buy the options.
you have to exercise the options if
Yeah.
you leave.
Yes,
And that was probably in the fine print somewhere at the beginning.
it was, and I saw it.
Okay.
You know,
Because you're a
the,
smart lawyer.
but I mean, the thing is, you can just buy them and hold until, you know, something happens with the company, so.
Yeah. Buy, hold, and get old, as Don was saying, right?
Amen. Yes, Sarah, we ours is a time vesting and performance vesting. So if you leave whatever's vested at the time, in my current company, whatever's vested at the time is yours. You forfeit any of the performance pieces. We didn't issue any options. I know in my venture company that I did after the Gentiva sale, if you left, you had 90 days to exercise to buy your options out.
Same here, the 90 days.
And that's certainly
Yeah.
very customary in the venture world. I think among other things, there's some internal revenue code reasons why that 90 days is there. There's good news. If you die, your heirs actually get up to a year to exercise. So hopefully that doesn't come into play.
That's extreme, Chris. That's extreme.
Exactly. That's at least a possibility. But I think a couple of things that I would add to this thread is that where you really have some potential for weirdness is your option in the venture world has a 10-year life, meaning it must be exercised by the 10th anniversary of the date of grant. And if the company has done well, but has not gone liquid, you have this situation where, to Sarah's point, you may very well have to exercise the option. If something had happened along the way that converted the option from an incentive stock option to a non-qualified option under the tax code, not only do you have to pay the exercise price, but you have to pay tax on the gain. And this can get really weird to the extent that there's not cash around the table to pay the taxes.
Yeah, so that's really tricky. That's really tricky. And I mean, I think I took every course my law school offered, and I understand like 1% of it. But Chris, you had a good explanation in our warm-up session on vesting and single trigger, double trigger, because those are some things people could potentially negotiate for. Can you touch on that a bit?
Yeah, a single trigger is full acceleration of your option upon an acquisition. So for example, assume that you got an option on March 12th, 2024. Typically, you would not vest any of it for at least 1 year, and then it would become monthly thereafter. Assume that the company got sold on June 30th of 2024. In a single trigger world, you would get fully accelerated for the entire, as if you had been there for 4 years in this example. So you get something in the nature of a windfall with a single trigger. A double trigger would require both the acquisition and your termination by the acquirer. And so if you are, for whatever reason, continue to be employed, you would just continue to vest in that example. There also can be variations on that theme where you might get accelerated by 1 year instead of fully accelerated. So those are the things that you'd probably, obviously from a certain perspective, single trigger is best. That's frequently hard to get, but people do have an understanding that the first person to be fired in an acquisition is highly likely to be the general counsel. So the double trigger is probably not that tough an ask. Particularly
because lawyers are so lovable. Is that what you're saying, Chris?
Exactly. But
nobody wants us around.
Bob and Anna working for you, you should be able to get the double trigger.
There you go. I love that. I guess we're closing in on the end here, and we've got some great questions in the chat. I'm not sure we'll be able to get to all of them, but what I typically see is an offer letter, and then I see a separate profits equity document. But what maybe in closing, what advice would you have for those of the lawyers who are listening in here on negotiating your deals? What would you ask for, or any special insights?
I would say with private equity, the employment agreement can be very similar to what you find in public company. So there are probably public company employment agreements out there that you can take a look at and get great provisions from that you can try to negotiate with the private equity. Sometimes it will work and sometimes it won't. And you can also rely on Bob and Anna to help you with that.
We did not pay Sarah for that plug, but we appreciate it.
Right.
You could get your own attorney too. That's another thing, is that there are lots of attorneys who actually specialize on the employee side with negotiating those types of deals.
Yeah, there are. That's a great point, Sarah. I had a candidate I was working with who brought in a comp expert attorney, and she basically walked away. I mean, what she was told was that my client was just way below market, and I think she might have been right. So, but she would not have had that perspective, right? I mean, that's the problem. It's like so many things in life. You only do it a few times, and by the last time you're pretty good at it. It doesn't help you in the first couple times. But John, I think I cut you off.
No, I was just laughing because that's exactly, what happened in our last foray. That was, was significantly undervalued. But I think, Sarah said earlier, utilizing a public company as a comparison to kind of gauge where you are is super helpful. You're not going to get any kind of, unless you have colleagues who are, in the same boat as you. But utilizing the private equity, the public company in your private equity negotiations is super important. And the other thing too, I think, making sure that your employment agreement, your triggers are reviewed by an attorney. We all try to be our own attorneys when we go through that. And you'll find, as you just mentioned, having that expert is super helpful to kind of cut through a lot of that and really understand if you're going in for your first time.
Yeah. And Chris, one of the questions that maybe you can see it in the chat is, you go from private to public. And if I recall, Bandwidth, you guys started VC and then the IPO. So the question was, is that lucrative? And I think the answer is a big fat yes, but I'll let you address it.
Yeah, the answer is yes. It customarily is lucrative. One of the things that's beautiful about an IPO in a venture world is that all those liquidation preferences that I was discussing get kicked to the side. Everything automatically converts into common stock. So there's suddenly an alignment that really benefits the earlier common holders. Otherwise, to the extent you have options, they continue to be options. You could then exercise them for shares and presumably immediately resell them in the public markets. The biggest thing that immediately happens, however, is you are subject to a 180-day lockup minimum. So you're not going to sell within 6 months after the IPO. Occasionally, you may see longer lockup periods. Secondly, you're also going to, particularly as general counsel, going to be subject to MNPI or material non-public information that will restrict your ability to sell. So you typically would end up having to think about what's known as a 10b5-1 plan or something else in order to liquidate your position. So it's a fantastic thing, but it does not mean that you're immediately seeing riches on the day of the IPO itself.
There you go. And Lauren, I know we're closing in.
About equity grants to lawyers below the GC pre-IPO. Is this unusual? In our experience, it is not unusual. We do see equity grants to lawyers below GC pre-IPO, especially if they're AGC or DGC level, usually not for very junior lawyers.
Absolutely.
Well, fortunately, we're coming to the end of our hour together. I just want to thank everyone who attended, and thank you so much for your insightful questions. It's been a really nice conversation. Thank you to Chris, Sarah, and John for your expertise. Thanks to Bob and Anna for leading this conversation. As I said, everyone will be getting an email with this recording. There's a lot of information here, so I know I'm going to go back and watch it again, and I learned a ton. Thank you, everyone, for joining. And if you have any other questions, comments, Bob and Anna's contact information will be on our email, so reach out to us. We'd love to hear from you. Thank you all again for joining us today.
And Chris, Sarah, and John, cannot thank you enough. So helpful. Appreciate your transparency and sharing all this. So thank you.
Sure.
If we could give you a round of applause, we would, but I don't know how to do that.
Thank you all.
Thanks much.
Right.
Bye.
Bye.
Thanks, everybody. Appreciate it.